Thanks for joining us yet again. Sage here for Kalkine Media. Today we're covering an educational topic called trend analysis. So what's trend analysis? It is the part of technical analysis that tries to predict the future movement of a freely tradable asset upon incorporating the historical and present price behaviour. The rationale behind trend analysis is that what happened in the past is likely to be repeated in the future under the same circumstances. Types of trends. Trends could be broadly categorized into three. This is long-term or primary, intermediate and short-term. Dow Theory. Charles Dow, the father of technical analysis, was one of the first of the modern technicians to identify and write about the fact that markets trade in trends. Dow Theory is basically built on three principles, which are as below. The behaviour of the trend remains the same regardless of the time frame under consideration. This is trends are fractal in nature. The primary, the intermediate and the minor are the only time horizons which Charles Dow associated with tides, waves and ripples, respectively. The trend tends to continue rather than reverse, which is perhaps the most important observation, as any particular trend is influenced by its preceding larger and next smaller trend. The direction of the trend. Defining the direction of a trend is one of the most important aspects of trend analysis, and primarily there are only three directional trends in the market. These are an upward, downtrend and sideways or consolidation. Generally, when prices of a security under consideration show peaks and through at higher price levels than the intermediate previous peak and trough, the trend is said to be an uptrend. The exact opposite of such a price behavior is what is considered as a downtrend. However, sideways or consolidation differs in that prices of the security under consideration neither show consistent higher peaks and troughs, nor do they show consistent lower peaks and troughs. In consolidation, prices tend to oscillate between a price range. So how to identify the direction of a trend? 1. Trend lines. The method primarily suggests connecting the price action over a time horizon under consideration to form a line on a chart by connecting either the highs of the price range or the lows. Moving averages. A moving average could be defined as a constant period average of prices calculated for successive periods. 3. Regression lines. Regression is ideally defined as a mathematical formula that can fit two dependent variables in a straight line, which is known as the regression line. Thanks for your time watching. Sage here reporting for Kalkine Media.